So, we're going to work through these now, one step at a time, starting with the need for disability insurance. So in order to establish the need for disability insurance, the first thing that we're going to do is we're going to look at this person's income. Now, income could come from any of a variety of sources. We touched on this already a few minutes ago, but now we're going to go into more detail here. So we could have employment income, for example. In addition to employment income, we might have investment income. Two fairly common sources of income. I would include in investment income things like income from a rental property. Very similar to investment income. We might also have a bonus paid as a result of employment. You might not work directly for a salary. Instead, you might be paid on a commission basis. Many people who work in the insurance industry find that they are able later on to generate income in the form of trailer fees or renewal fees, which is the income earned in exchange for servicing products that are sold in the insurance industry. If you happen to own a business, you might generate some business income. Now, some of you might have noticed that I've broken this down into two columns. What you'll see on the left side is what we call active income. And by active income, we mean income that you actually have to get out of bed to go and earn. So you actually have to haul yourself out of bed, go to work, earn this income. The nice thing about the income on this side, on the right side of the chart, is that this stuff is not so dependent on your ability to go to work that day. These would be examples of passive income. There are others that we didn't talk about here. If you happen to be somebody who, for example, helped to write a book at some point, you might generate some royalty income. That would be another source of passive income. Now, you'll see that I put business income in the middle. Well, business income could fall on either side depending on our scenario. If you happen to own a small business, your business income likely falls on this side. That is, if the business counts on you showing up to work every day to help generate the revenues that the business creates, then likely this business income is active income. However, if you're involved in a larger, more robust business and you have, let's say, managers working for you and salespeople working for you and several other folks who work to make sure the business works every day, then likely that business income has more of a passive nature. Now, when we're selling disability insurance, we're going to insure the active income. So this is the income that's insurable. Or, in the context of the Insurance Act, we would say that your insurable interest would be roughly equal to how much active income you generate. So you have an insurable interest in your ability to earn income up to the amount of your actively earned income. Now, that being said, it's not necessarily the case that we're going to insure all of this income. Here's what happens. We add up the total of all of your active income. Let's say, for this particular person, it happens to come out to $72,000 per year. Great. That's a fairly reasonable annual income. This person probably does okay. We say now, when we're putting disability insurance in place, because disability benefits are paid with after-tax dollars, we want to take this into account. We don't want this person earning more income while disabled than they did while they were healthy. If they end up earning more income while disabled than they did while they were healthy, we would say that takes away the motivation to go back to work. We want to make sure there's a motivation in place to go back to work. So, here's what happens. We want to bring this income to approximately the same level that it was after we took away this person's income taxes, keeping in mind that disability income is going to be tax-free. So normally disability benefits are calculated on a monthly basis. So we can see that this person has $6,000 per month of income. Now the insurer is going to say, we're not going to provide 100% replacement here. We're going to replace just a portion of that income that person had previously been earning. This depends on the insurance company that you're dealing with and depends on the contract that you enter into. But it could be any of these amounts, and there are some other possible variations here. But these are fairly common amounts, somewhere between 50 and 70% of your disability, of your healthy income is what we're going to replace here. So let's say for this particular person that we said we're going to provide a 60% benefit. 60, 65, and 66 2/3 are all fairly common in the insurance industry. So what we would see now is that this person, if they become disabled, and they had purchased this particular disability policy, assuming $72,000 of annual income, $6,000 of monthly income, a 60% benefit, this person becomes disabled, and they will start to receive, assuming that they meet the definitions of disability and their disability insurance policy, this person will start to receive $3,600 per month of disability benefits. This will be the disabled person's disability benefit, and of course it's paid tax-free because this person paid their individual disability premiums with their after-tax dollars, meaning that the product's already been taxed. Revenue Canada is more than happy then to watch you collect these benefits tax-free.